Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
The impact of gold price and US dollar index. Throughout history, civilizations have coveted gold. Even today, gold remains the ultimate prize. Gold is not only a prize and a symbol of wealth, it is also a metaphor. It's an honor to receive a gold medal, to be told you have a heart of gold, or to own a gold credit card. The exchange of gold bands symbolizes love and marriage in many societies. Gold is the ultimate symbol of the pinnacle of human achievement. Today it continues to be a psychological barometer of market sentiment. Gold is a rare metal. In the history of the world, mining has produced only 187,000 tons. The fact that governments worldwide hold gold as a foreign exchange reserve highlights the importance of the metal. Throughout history, many governments used gold to back their currencies, creating a gold standard. Today, while governments maintain hoards of this yellow metal, none use it to back their paper money. Gold is usually denominated in US dollars. Therefore, there is a relationship between the price of gold and the dollar, in that there can be an effect on gold prices as the value of the dollar rises and falls. While the relationship between the value of the US dollar and gold is important, the dollar is not the only factor that affects the price of the precious metal. Other factors that affect the value of both gold and the dollar are interest rates, inflation, monetary policy, and supply and demand. The prices of gold and the dollar may often appear to oppose each other due to investor sentiments and economic factors, but there is no set or official relationship between the two. Gold is an asset. As such, it has intrinsic value. However, that value can fluctuate over time, sometimes in a volatile fashion. As a rule, when the value of the dollar increases relative to other currencies worldwide, the price of gold tends to fall in US dollar terms. It is because gold becomes more expensive in other currencies. As the price of any commodity moves higher, there tend to be fewer buyers, in other words, demand recedes. Conversely, as the value of the US dollar moves lower, gold tends to appreciate as it becomes cheaper in other currencies. Demand tends to increase at lower prices. Gold does not yield interest in itself, therefore, it must compete with interest-bearing assets for demand. In other words, other assets will command more demand because of their interest rate component. There is also a psychological factor attached to the value of gold. The price of gold is often sensitive to the overall perceived value of fiat or paper currencies in general terms. Here's one way of looking at this relationship. There are approximately 330 million people in the United States, while the total world population is around 7.7 billion. Less than 5% of the world lives in a nation where the US dollar is the national currency. The role of gold as a currency is ubiquitous around the world. Throughout history, gold has been money. The ancient philosopher Aristotle wrote that money must be durable, divisible, consistent, and convenient, and that it must possess value in itself. Gold meets all of these characteristics. During times of fear or geopolitical turmoil, the price of the historic metal tends to rise as faith in governments falls. During times of calm, the price of gold tends to fall. As perhaps the world's oldest and most storied currency, gold is an essential barometer in terms of global economic and political well-being. Gold and stock market volatility. Gold is a long-lasting and valuable metal that can be preserved and recovered at any time while maintaining its integrity. It is a chemical element with a high atomic number, 79, and it is also known in the periodic table as Aurum, O. Since gold is regarded as a precious metal, it is traded in the futures and commodities markets as bullion or gold bars of different weights, usually grams and kilograms, or as a monetary asset. Being that precious metals are traded in commodity markets, they have attracted the international attention of investors as a safe haven, and as a substitute investment with a greater sense of positivity during chaotic periods. Not at all times is gold to be thought of as a safe haven for stocks. It is explicitly known for negative market shocks, as the attribute of a safe haven is short-lived. Research conducted regarding gold as a hedge or safe haven stated that gold is only a safe haven when it is most needed and is not supposed to be, nor is, so during periods of rising stock markets. The study by Bauer and Lucy, 2010, proved that though gold is a safe haven for stocks, in the long run, gold is definitely not a safe haven. As in the study states that hedge is described by Bauer and Lucy, 2010, as an asset that is uncorrelated, weak hedge, or negatively correlated, strong hedge, with some other asset owned by the investors on average. This study is also supported by Dar and Matra, 2017. China will soon be a significant gold consumer, according to the World Gold Council. In 2015, the WGC stated that, Hoang et al., 2015. A 30% drop in the Shanghai Stock Exchange, SSE, in 2015 resulted in a halt of trading for half of the listed companies to prevent further losses. When the stock market had a problem, the media frequently played up the myth of gold's inviolability. On average, gold is not a hedge, though it is a highly reliable safe haven under extreme stock market conditions during the same time periods in most Chinese stock markets. Ming et al., 2020. Gold is traded on the stock exchange. With its unique socio-cultural status, India is the world's primary gold consumer. For emerging markets such as India, gold is a weak safe haven at best. Looking at the peaks of certain crisis periods, gold is a strong and safe haven for most developed markets, while gold plays only a minor role in emerging markets against stock prices. Gold is bought to prevent stock market declines and to counter inflation. During the COVID-19 pandemic, most commodities in the market were disrupted, much like the stock and foreign exchange markets. According to Chenol and Zarin, 2020, the global primary product price declined by 37.3% in March 2020. However, it also reported that the precious metals sector increased by 5% during that period. The research studied by A. N. Sanza, 2020, revealed that the positive correlation between Shanghai financial stock markets and the COVID-19 confirmed cases is significant. I was having a significant positive relationship and impacting the stock markets of China. In the Q1 of 2020, regarding China's case, its retail sales and fixed assets dropped by 19.0% year-over-year, and 16.1%, respectively. A. N. Sanza, 2020. This had led the economy of China to shrink by 6.8% in Q1 of 2020. The case was Gold and Stock Correlation Under Uncertainty, in which Gao and Zhang, 2016, demonstrated that for the first time investors, when economic uncertainty increases, the shares for stocks drops drastically and demand remains constant, resulting in lower risk, higher quality assets, pushing investors to divest their stock holdings and allocate them to flight to gold assets, such as gold and stock react inversely. This significantly impacts both volatilities. Liu et al., 2014. H1A. Gold price has a positive effect on Shanghai Stock Exchange volatility. USD index and stock market volatility. The U.S. stock market is seen as the global information center, and any changes in U.S. stocks influence the volatility of stock markets worldwide, with an impact on foreign exchange markets, e.d. Su and Fen, 2011. Wu and Wu, 2017, mentioned the relationship between the U.S. dollar and capital market participants in their study. The literature showed that the relationship between the carry trade aggregate returns and the USDX5 futures prices appears to be more dissenting and continues in relation to the 2007-08 international financial crisis and the 2010-11 sovereign debt crisis of Europe. Though the dollar index shows an ambiguous relationship before 2008. This special circumstance can be interpreted as a fact that when universal risk disinclination becomes high, global financial traders seem to redirect capital to a more balanced currency, during which the US dollar inflates simultaneously. A strong positive symmetric volatility is USDX, implying that the investors turn to the US dollar as a safe haven instrument while the other currencies depreciated. Hosen, 2013, found that there is a significant influence of the US dollar index on the Jakarta Composite Index, i.e., if the USD index increases, JCI would decrease. From the perspective of an investor, if the currency declines, it shows that the condition of the economy is not doing that well. As a preventive measure, the investors will be instigated to either invest less in the capital market or liberate their stocks. Wherefore prompting the stock market, JCI, to experience a decline. The dollar index significantly influences the Hong Kong stock markets, the fact being that changes in exchange rate greatly influence the Hong Kong stock returns volatility. The US dollar index, though not directly, plays a crucial role in the Hong Kong stock market since the exchange rate of Hong Kong is highly affected by the dollar index, DAI, Zhou and Dong 2020. Considering the circumstances of the stock market crash and high volatility, the DXY acts as a worthy haven for DAX, BSE, and Nikkei 225, while it is an unreliable one for SSE, SP 500, and even BTC, Chima and Shulchik, 2020. Demand for liquidity is known to increase in times of extreme market crisis. In such situations, the flight to liquidity paradox comes into effect, in which the preferences of traders change, and the price of illiquid assets drops, and the liquidity conditions of markets start to take a downturn. Ben Raphael, 2017. The international flow of capital plays a significant role in defining the correlation between stock returns and currencies, in this case, USD, as they are a hedge trigger and flight to quality conditions. Due to this, investors from developing countries move towards investing in developed currencies as a natural haven, especially if a sudden crisis were to occur. Cho et al., 2016. Gaussian, 2014, studied over a period of a pre-crisis and post-crisis era of the Indian markets and analyzed significant volatility spillover from the Indian stock markets and other financial market segments to foreign exchange markets. The dollar index has been proven to have spillover effects from various stocks but should be invested in depending on the time as it is a high-risk and high-return index. According to J. Bin Su, 2016, investing in the dollar index pre-quantitative easing can lead to higher returns, whereas investing in the dollar index can lead to a lower expectancy in post-QE periods. H2A US dollar index negatively impacts the Shanghai Stock Exchange volatility. Discussion. In the study's first analysis of the volatile rate of the year 2019 and the year before the novel pandemic struck, it seems to show that there was always a volatile presence of in relation to stock markets and the gold price and dollar index. As the GARCH analysis has proved in Table 5 that DXY volatility positively affects BSESN volatility, this proves that H2B is not accepted. This is in line with a study conducted by Shafula et al., 2020. The literature proves a positive effect between the two variables. A rise in the US dollar price also causes an increase in the BRICS stock index and vice versa. Prior to the COVID-19 in the case of the SSE, the dollar index returns, DXY, negatively impacts the stock market. Mikhailov also proved this where the study proved that money markets, namely US dollar, have a negative volatile spillover effect on emerging markets, thus proving hypothesis H2A is acceptable. The result also depicts so in the case with gold price, GC, volatility, where the volatility of GC negatively impacts Shanghai Stock Exchange volatility. This portrays that in normal economic conditions, Chinese investors use gold as a hedging commodity for short-term periods as they are more accustomed to responding to stock market news, which tends to make them irrational traders, as stated by He et al., 2020. We can see that the majority of the stock market still had a negative impact on the emerging markets prior to the COVID-19 pandemic. During the COVID-19 pandemic, H1A has been accepted since gold price return and volatility seem to affect the Shanghai Stock Exchange positively. This is contradictory to previous year's findings, implying that even though the COVID-19 pandemic existed, gold is and has been a long-time safe haven and hedge to most Chinese investors, and the fact that the breakout of COVID-19 did have a major impact on several other financial markets, the Chinese investors reacted in a historic fashion by pursuing short-term security in commodity markets during the COVID-19 as a measure of flight to safety. However, considering the positive spillover effect from gold to SSE volatility proves that the measures taken by the Chinese government by imposing lockdowns to reduce the spread of the COVID-19 virus and other safety measures have seemed to benefit in recovery of the markets. This finding is also in line with Corbett et al., 2021. As there is no negative impact, it should translate that new investors looking to invest this as an opportunity to invest in relatively low-priced stocks in a bear market economy. In the case of BSESN, gold volatility seems to have a positive effect, while gold returns appear to have a negative effect. It has been studied by Reboredo, 2012, when investigating gold's nature of safe haven, that in terms of crisis, investors transfer from high-risk assets such as stock market into more reliable assets such as gold, which in turn causes the stock markets to crash while appraising the price of gold due to increased demand. It appears that has also been the case during the COVID-19 pandemic, where investors are switching between assets to improve the effectiveness of their risk-return behavior. This conclusion is also on par with the results of Jane and Biswell, 2016, as the GARCH results of Table 4 and 5 show a bilateral interrelation where the fall in gold price leads to a fall in the Bombay Stock Exchange Sensex and the fall in the Sensex leading to an incrementation in gold price. Hypothesis 2A and 2B seem to be rejected in the case of the volatile independent data's effect towards both the dependent data. However, it can be observed in Table 4 that DXY returns has a significant negative impact on SSE volatility, which approves H2A. This implicates that with the fall or rise of the dollar index, the SSE will face an opposite effect. However, this being said, the result is the same as the occurrences of the previous year, i.e., the pre-pandemic era, which shows that with or without the economic shocks, the US dollar index's effect on Chinese financial markets remains unchanged. This could be due to the fact that the Chinese government, though they claim to be a managed floating regime, do intervene significantly in the exchange rate determination and also pose heavy regulation on everyday stock market price movement so as to shield their stock market from foreign capital movements causing high volatility in the Chinese financial markets. Naresh et al., 2018. The overall analysis of the combined data of the years 2019 through 2020 shows that in all significant situations H1A and H1B is accepted where gold price return positively affects SSE volatility and gold price volatility positively affects SSE and BSESN volatility. This may not only be due to the fact that investors seeking safety during the 2020 crash turned to as a hedging mechanism, but could also is possibly due to the other fact that India and China are the world's highest consumers of gold not only as a commodity but also for cultural and traditional jewelry, ornaments, etc. On the other hand, DXY return and DXY volatility has had a significant positive effect on SSE volatility, completely disproving H2A, while DXY volatility has proved to negatively affect BSESN volatility, proving H2B acceptable, as India is a developing and emerging market whose financial markets are highly influenced by USD, IDR exchange rate, unlike China, who is one of the world's leading economies and have high government intervention when concerning financial and economic factors. Conclusion, limitations, and suggestions. The research was done on this paper to prove that dollar index and gold price have had opposite effects on BSESN. This paper examined the role of GC and DXY in 2019 during the outbreak of the coronavirus in 2019. The daily data of GC, DXY, and SESN served as independent variables to identify the significant influence. Studies report price volatility over time. The daily data was all used from January to August 2019 and August of 2020, as well as a merged daily series during these dates. The effects of COVID-19 ruled the stock markets since December 2019 and had already manifested in Chinese markets by February. This study, therefore, used data from January. Unit roots were first checked using the ADG methods, and no information was found, making the normality test applicable. Finally, the data was modeled using GARCH to calculate the amount of volatility. The study found that gold, ever since being used extensively as a hedge, trusted, and resorted to in both India and China, had a huge impact on the volatility of BSESN and SSE. While DXY, since it influences the USD, IDR exchange rate, did have a significant impact on BSESN. Although the significant impact of DXY towards SSE was very limited due to the strength of the Chinese economy, the rate at which the Chinese yuan responds to the dollar index, and the heavy influence and intervention of the Chinese governments toward financial policies and prices. The intention of this study determines how the financial markets of China and India, namely, Shanghai Stock Exchange and Bombay Stock Exchange Sensex, are volatilely sensitive to two of the most major influencers of stock market spillover and trader mentality, i.e., gold price and the dollar index. Knowing these adverse effects can help government policymakers regulate or intervene to control extreme volatility, take timely action, and even prevent market crashes and negative spillover effects. Even though this study proved the gap in the economic standing of both the emerging markets and how India is more vulnerable to the US dollar rate, and also how China, even though highly influenced by the pandemic, seemed to handle the after effects of the shock relative